Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different aspect from the world of investment and look to apply the rules of the craft, as laid down by the man widely considered to be its founding father, Benjamin Graham, to the problem at hand. In this episode, we should be taking a look at one of the most important documents to the value investor in business accounting, that is, the profit and loss account. We will consider the individual lines that make up this specific document and how the investor can attempt to decode it to arrive at a meaningful estimate of underlying earnings, which then can be used to help place a valuation upon a business. So without further ado, let's dive straight in. So as ever, sit back and get ready to digest another lesson in value investment, as inspired by Benjamin Graham. Anyone who has had the pleasure of reading a company's annual report, specifically the part dedicated to the company accounts, will know that for the uninitiated it can feel a somewhat daunting task. Sometimes the part of the report concerned with the numbers can reach hundreds of pages long. Where to start, any new investor may very well ask. Fortunately, the most important parts from the standpoint of valuation can be found on just several pages. This will comprise the balance sheet, the cash flow statement, and what we're here to discuss today, the profit and loss account. The profit and loss account, sometimes also known as an income statement, is a section of the financial report that breaks down and summarises a company's revenues, expenses, and net profit or loss over the period. This is a vital document because ultimately the amount of money a business makes will be one of the prime factors we need to know about if we wish to decipher what a business should be trading at, as opposed to the price placed upon it by the stock market. The profit and loss account is typically a very concise document, rarely covering more than a page or two. So in theory at least, it should be a pretty easy thing to grab all the essential information from. But in reality, oftentimes they do require some scrutiny and more than a little deciphering if we are to take away meaningful conclusions from them. The chief goal of the value investor when faced with a profit and loss account should be to arrive at what they feel confident is a fair and undistorted representation of that year's operating results. But as ever with these things, it is sometimes easier said than done. The thing that makes this a trickier endeavour than it might otherwise be is the use of accounting artifices to present what can sometimes prove a misleading picture. Direct fraud is thankfully a very rare occurrence when it comes to company accounts, but there are perfectly legal and acceptable methods from an accounting point of view that can be used to massage the figures in a direction that, for whatever reason, suits the picture the management team wishes to present. The final net profit or loss figure, which is of course of vital importance from a valuation point of view, can be distorted to the point of meaninglessness by these clever accounting techniques. There are many crafty ways accountants can perfectly legally bend the results to their whim. A special attention here should be paid to irregular or non-concurrent incomes or outgoings that do not form a part of the day-to-day operations of a business. An income account is at its most meaningful when it relates solely to the normal operations of a business, and it is the goal of the value investor to decipher and, if necessary, adjust the final net profit or loss figure to reflect this. Some of the factors that may distort what normal operations look like exactly is the inclusion of certain incomes or expenses that are perhaps one-off in nature, or ones where a decision can be made, often arbitrarily, to include those gains or losses instead to surplus, or to carry over those often paper gains to subsequent years. An example might be the sale of some asset or another, the sale of a property owned by the business, say. This would clearly be a one-off financial event, but is often claimed in the profit and loss account as a form of derived income. Whilst in a literal sense it is, it clearly distorts the earnings picture for the value investor, as that one-off gain will be missing from future years' earnings. There are plenty of other examples of one-off windfalls, often included as being operating revenues, such as tax refunds or write-downs or markups in the value of inventories. Including these one-off events as operating incomes is a frequent cause of misvaluation, as unless the net income or loss is adjusted to remove their effect, investors can sometimes wrongly assume that the figure presented is an accurate reflection of normal and typical business earnings. Of course, incomes or losses of a one-off nature, if they are tangible and real, will need to be reflected in any valuation, but this is better off dealt with by reference to their effect on the balance sheet, which we can look at in more depth in another episode. The important thing is the value investor contents oneself that the figure presented by the business is a true reflection of normal and typical business operations, and if it is not, adjust it to remove the distorting effects of one-off fiscal events. The investor might ask themselves why the management of a business might seemingly go out of their way to present what can sometimes be a quite arbitrary figure when it comes to net income. A cynic might propose that this is because bonuses are often tied to reaching certain financial targets, and if they can hit this target using quite legal accounting practices, then why wouldn't they? The good news for the value investor is that they too can profit from this questionable activity. It is too much to expect for investors in general to look to anything but the headline figure as presented. But those who realise that this figure is sometimes an unreliable guide to future earnings can choose to adjust their outlook to the financial reality or otherwise walk on by. Another way for the value investor to confirm what are typical operating earnings, as distinct from ones padded by extraordinary events, is to compare today's accounts to ones from previous years. It is absolutely vital that the value investor look back at the results for a good number of years to fully understand if the current earnings exhibit is a good guide to the future. For even earnings that have genuinely derived from normal business operations can come to deceive the investor when they attempt to draw conclusions as to whether these earnings are typical of a normal year and are therefore useful to be used to arrive at an intrinsic valuation for the business. For example, anyone looking at the accounts of Moderna, Peloton or Zoom during the height of the COVID pandemic should have drawn the conclusion that the levels of income being seen during that period was of an exceptional nature. Unless you were someone who believed the pandemic was going to last forever, then the conclusion should have been drawn that sooner or later, future earnings will start to look a little more like those of the past. The COVID event was unusual, of course, but many businesses operate in cyclical industries that regularly go through periods of boom and bust. Today's results may be a decent enough representation of what operating results look like in a boom cycle, but to arrive at a solid, sound conclusion as to what price a stock deserves to sell at, that periods of bust will inevitably be in the offing. In conclusion, we can say that the income account is one of the most important pieces of information that any value investor must seek out and refer to when considering what price a stock deserves to be trading at. This document is typically small and concise, but is replete with dangers to lead the investor astray. The value investor must do their best to take into consideration forms of income or expenses that are of a non-recurrent nature, and wherever possible, adjust the net profit or loss amount to reflect this reality. Only an earnings figure that truly represents what might be typical and usual can act as a useful guide to what results that business might expect in the future. The value investor will also do well to look back to historic accounts to arrive at a conclusion if the current operating picture is a good representation of likely future trading conditions. The income account will of course only be one factor to take into consideration when arriving at an estimate of intrinsic value. The balance sheet, the cash flow statement, as well as other considerations, will also play vital roles in this endeavour, and we will of course take a fuller look at these in future editions. To conclude the episode, I shall briefly mention the term EBITDA that you will very likely come across when studying income statements. The acronym stands for Earnings Before Interest, Tax, Depreciation and Amortisation. The late great Charlie Munger, Buffett's right-hand man at Berkshire Hathaway of course, said that every time you see this, you should substitute the words to bullshit earnings. And as with most things, he is dead right. On that note, we shall draw today's podcast to a close. As ever, I hope you've enjoyed it, and if you have, you know what you can do. Add to playlists so you need never risk missing a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.